Good morning. This is Carl Dakin, and this is my Successful Funding Show. For those of you who are new to this show, it's a weekly presentation on topics about funding. Most of our conversation has to do with small businesses and community projects. This morning, I have as my guest Jeff Dangremond, who has held a variety of positions as a wealth advisor, and we're going to talk about what it takes for a person to make an impact investment. Because today, as a lot of you who are out looking for dollars may find that competing for investment dollars strictly using a return on investment analysis may not make the job happen. So we're seeing a lot more people who are using impact investment, putting purpose alongside or ahead of profits as a reason for them to invest or to choose one business or project over another. So, with that, I invite Jeff to the program this morning. Jeff, please provide us with your background on where you've been that got you to today to be a guest on today's show, and then give us some of your opening thoughts on why would a person make an investment based on impact.
Absolutely, Carl. Thank you for having me and inviting me to this morning. I'm looking forward to this conversation and talking about these issues. I guess the first and most important thing to say is that absolutely nothing that we talk about today is financial advice. Any advice that you want or that you need, you should contact your financial advisor. Anything that we're talking about this morning and everything that we're talking about this morning is educational only. So I have a background in finance as well as sustainability. I spent a large part of my career with very large financial institutions, and as such, dealt with both companies and individuals who had a focus on not only doing well, but doing good. They wanted to help their communities. They saw the benefit of having a good, strong community, and they built their companies and businesses based on that. So that led me to additional education. I have not only an MBA from Arizona State University, but I also have a Master of Sustainability Leadership from ASU. And this confluence of finance and sustainability, especially as it relates to things relating to ESG, as well as then specifically impact investing, for instance, is, I think, very important, not only right now, but into the future. I see generationally that there are differences between um, older generations and how they invested their money and what their focus is, and new generations that are perhaps prioritizing things a little bit differently, or in some cases a lot differently than what the previous generations did. So, but yeah, we could talk about impact investing and who impact investors are. Again, I won't get into any specific recommendations for uh, an impact investment. I can talk just thematically and generally about things, and that's what certainly my intention would be to do today.
Yeah, so let's start with the alphabet soup surrounding impact investing. There's the term ESG. I think I saw a new one yesterday called DEI or DCI. There's a bunch of them. What do all these letters stand for, and why are they important?
Yeah, great question. ESG it stands for environmental, social, and governance initiatives. And it's a concept that's been around close to 20 years, but it's really come into part of our lexicon, I think, really in the last five. You hear about it a lot, and there are a lot of political issues related to it. But ESG is just an assessment, in my opinion, an assessment of risk. So whether you're a financial institution who is wanting to lend money to a borrower, whether you're an investor who's trying to analyze the risks associated with your investment. Theoretically, you want to take the least amount of risk for the highest return. And you, as a financial institution, want to get paid back. So the last thing you want is to uh, have detrimental things happen related to a particular company that you didn't analyze, that you didn't see. And so people are very, very good about analyzing financial statements. We have, 100 plus years of methodology to analyze, how a company is doing, and all kinds of ratios, and any number of things to measure the quality of the finances of a particular company. But beyond that, I think there are things that are associated with risk that are non-financial, and those would be the E is in terms of environmental. If a company is doing things that are detrimental to a community or to the environment, you as an investor or you as a lender want to know that. You want to know that because the ability for the public to know about bad things that are going on is almost instantaneous now. So if it's found out, for instance, everybody knows the issue that Nike had because one of their subsidiaries was employing child labor in Southeast Asia to build and create their shoes. That's just not good. That's just really, really not good. And activists have figured that out. Activists have figured out that it doesn't necessarily do any good to stand outside of a company with signs protesting. But if they stand in front of the financial institution and say this financial institution is lending money to this company that's polluting the environment or doing bad things in the community or treating their employees badly, makes an impact. And so as a lender or potentially as an investor, you want to know about these risks. So with all the political noise related to this, really what I see ESG as is just a risk assessment. And that's probably not a surprise given my background in finance, but that's what it is. And DEI, you mentioned DEI is diversity, equity, and inclusion, and that's part of the S in the ESG. As a society, if you take the position that a rising tide floats all ships, you want everybody to be able to play on a level playing field. You want to get the best out of all the people that are involved in a particular activity. And I think that there's a real benefit in making sure, especially if you are a seller of products or services, that it's not just specifically to one group, that you're involving people, with a spectrum of backgrounds. So that's what that is.
So all kinds of letters, all dealing with topics that have to deal with purpose. We've had people talk about people, planet, things like that. But as you said, there's a long history of measuring financial returns, but we seem, and I've been dealing with this for almost 20 years, where how do you measure purpose? Purpose is highly subjective. It seems like one person's preferences on what might be good for the environment might actually be counterproductive or opposed by somebody on the other end. So how do you go about measuring all these different things?
Yeah, it is interesting. It's a really interesting question, and it's one that certainly is evolving. The evolution of the measurements and metrics associated with ESG continue to evolve. There was a lot of fragmentation in terms of that analysis, and what you're seeing is a coming together of methodology to make those measurements. In some places, in some cases, for instance, the European Union has their taxonomy, and so those are rules and regulations that are associated and apply to businesses that operate and do business in Europe. And so it is becoming a regulated activity, and there are measurements associated with those activities. They're not perfect. There is still an evolution that needs to take place. We do not currently have in the United States those same types of regulations. There certainly is a focus. There's a focus by the SEC, by the Comptroller of Currency, by the FDIC, to make sure that banks are paying attention to issues related to ESG, because they see that as potentially a threat to the stability of the banking system. But there's nothing that's been put into a regulatory frame yet, and I think that it probably will happen. I know that there are companies that are based in the United States that do business in Europe that are having to comply with the measurements and the reporting that the EU has put in place and requires. And if that's an activity that's going on there, then it's just natural that they'll do the same activity here. What's really leading this, Carl, in a lot of ways, are companies making the decision to do this. And so here's where I always like to differentiate between ESG and sustainability. A lot of people use those interchangeably, but there's a difference. ESG is how the world, and so regulations, for instance, impact a company. If you're required to do things from an environmental standpoint, if you're required to do things and it makes sense to do things on a social level, if the board of directors indicates that compensation for executives on the governance side is going to be based on key performance indicators related to the E and the S, then those become very important and can be measured. Sustainability, on the other hand, is the impact that the company has on the world. So what kinds of activities is the company undertaking that impact the environment, that impact society, that impact the community? And so there is a difference. It's subtle and there's overlap. If you draw a Venn diagram, you're going to see an overlap between the two. And I think that's why people use them interchangeably, but there is a difference, and it's an important difference to understand.
Well, we've had environmental, we've had environmental standards for a long time.
Mhm.
So we had leads standards for buildings, and even that has a number of flaws in it because it's too highly subjective. Again, you could have 5 people review a building and give it 5 different scores, and even though it's held out as the leading thing, it's difficult for a person to determine if they're really in compliance, because you may get a score for one thing that is offset by something else that's not scored. And we had a number of problems. I worked with public benefit corporations here in Colorado, like a lot of states. We passed a law that said that you could create a new corporation that would be for the public benefit. And we had to make amendments to state laws so that no longer were the board directed to maximize profits for the benefit of shareholders. They were allowed to include purpose as an outcome. And we had battles with other groups who all wanted to dictate what those standards would be. And when you looked at those standards, they had their own slant, their own agendas. Not necessarily that they were bad, but you'd have sometimes environmental stuff giving 80% of the weight on the scoring, and stuff with S in the G, the social and governance, getting little or no points whatsoever. Similarly, I've seen some stuff come out where they're like, well, we need equality on the board. And you saw people being put on boards of directors who did not have the experience, did not have the understanding of what was going on. They were figureheads. Not that they're bad people, but simply there was a disparity in the quality of members of a board as people were trying to conform to these imposed mandates. And A lot of this is at the higher level, meaning that these rules and so forth are being imposed more strongly on publicly traded companies, ones that are traded on Wall Street. But very little is, I will call it, trickling down to the small business community level.
Right.
Here, it's not so much a regulatory mandate, but it seems to be more like a voluntary compliance,
Right.
where people who want to stand out to differentiate themselves from everybody else, and this is like a competitive brand advantage. They're saying, "Hey, look what we're doing. We're doing good for the planet, good for the people, good for our community." And I think that we're seeing some major changes, however slowly, but major changes taking place when we get down to the community level. What are you seeing in that regard? What do you think is going to happen?
Yeah, I think so too, and those are really great points. There has been a tendency to greenwash. It's a term that has been used recently because a lot of people have said, "Oh, well, sure, I'm going to be net zero by 2050," and if you ask them, "Well, what are you doing today to make that happen?" Well, I don't know. I guess they're going to wait until 2049 to figure it out. But you know, as far as small businesses go, there does tend to be a trickle down effect after a period of time. For instance, again on the financial side, when you analyze financial statements, you pretty much analyze the exact same thing. This is certainly more complicated when you're dealing with a Fortune 500 company and it's massive number of subsidiaries and everything else. But the analysis is pretty much the same, whether you're reviewing a Fortune 500 company or somebody that's got a revenue of $5 million a year that is just based in a single community. And so when I talk about trickle down, I think ultimately as financial institutions put systems and processes in place and a methodology in place to do an analysis related to non-financial risk, that those types of activities will trickle down to even the smallest businesses, that it'll just become part of the credit analysis or the credit decisioning process that exists in financial institutions. And I've noted this before. There's nothing that will focus pointedly one's attention than a threat to the access to capital. So if your bank says, "I can't give you this loan until you give me an analysis of how much water you use," pretty sure that the next day that company is going to be able to report how much water they use. And this is not something that maybe they did in the past. It's not something they maybe cared about in the past, but it's something that's important that they care about in the future. Being based here in Arizona and certainly up until the last year, the level of drought that we had here and the impact not only here but in Southern California. Water usage is a real issue. It's temporarily set aside now because we got a lot of rain and snow, but it is one that is going to be an issue in the future. Carl, when I was born, there were 3 billion people on the planet. There are 8 billion people now. There was a mindset when I was growing up that resources were endless, that you could just do anything at any point in time and draw on resources, and it's okay. It'd be a problem. I don't know how it was ever thought that it was a good idea to put a pipe out of the back of your factory and flow it into the creek or the river. I don't know how that was ever a good idea for anybody, but we look at that now and it's just like we can't do that because we see the impact. We see the impact to communities, with industry being located in communities that has polluted the groundwater, has polluted the soil. The impact that has on the health of that community, the degradation that takes place within communities because those types of activities are happening or have happened in the past, and what can be done now to remediate those issues and to be more fair in terms of where plants are located, how those plants are operated. I think it's a natural human condition that we all want to be healthy and live healthy lives. And if I see government doing anything, it's making sure that that's the case, that You can't subordinate a particular community just because they don't have the income demographics that another community does, and stick a plan in that community and not really care about it. I just don't. I don't think that's the case. So we're not starting with a blank slate. We're dealing with issues that already exist. I think the best thing that can be done by financial institutions is to really take a look at affording options to companies. For the example that I gave a moment ago is if a bank wants to measure the water usage of a particular business, that business hasn't really looked at that before. But if the bank can provide a methodology for that business to do that, make it easy to provide that information. If the water source can provide information in a way that's useful. This is not just information that's for the benefit of information. That it's actually doing something. It actually measures. Well, the measurement is okay. This is how much we use. What can we do to reduce that usage? What can we do to be more efficient? And I think companies in general, when you talk about efficiencies, that's what they want because the greater efficiencies you have, the greater your margin is in terms of profitability. And so, that's the competitive nature of business. And so I don't see why people would be necessarily opposed to this. I know it's become very political, and I know that people are like, ESG and it's the devil, and it's not. It's a risk assessment, and people given the opportunity to do things differently, I think will take advantage of that. Not only individuals but also businesses. And so it's an interesting conundrum. It's an interesting challenge that financial institutions have, that communities have, that individual investors have, to fold these ideas and concepts into what it is that they do. Instead of business as usual, we're only going to do a financial analysis. We're only interested in short-term profits. That there's much more of a long-term focus associated with viewing non-financial risk. Yeah, this is great. We could make all this money now. Fantastic. Everybody's happy. Everybody's rich. But what happens 10, 20, 30 years from now? What is the impact on, like we're talking about, neighborhoods that have been adversely impacted with pollution?
So there's a lot of data out there today that indicates that poor communities, economically distressed communities, almost certainly have a higher level of pollution, other negative factors that impact that community and tend to hold it back, to repress it from having the same quality of life that we might see in a more affluent urban suburb. And yet at the same time, as you pointed out, we're not starting with blank slate. So here in Colorado, as an example, the legislature passed a law that said anybody with a building over 50,000 square feet needs to bring this to a higher degree of energy efficiency over the next several years. Well, the challenge here is that can that even be done with a building that is 30, 40, 50, 100 years old? And that's a technical question all by itself. It might be that it's impossible. So what are you going to do with that building if you cannot bring it into compliance? Are you going, the building owner, are you required to destroy it and take a loss on that? Because the state's not providing any funding whatsoever to compensate people for this. So that you get into a government question: are they imposing mandates with cost, with no assessment for that? So we have that particular issue, and then we have I'll call it a cascading issue, where we find a building. The building owner says, yes, I can meet the compliance, but it's going to cost me to do retrofits on my building. Well, we all know that the building owner is going to pass through these costs to the tenants in the building. Sure. And the tenants are going, well, I was paying so many dollars a month for a lease or rental of the building, and now, because of these imposed standards, I've got to pay a higher amount, and it may be 10, 20, 30% more than what they were paying before. Right. And as usual, this rolls downhill, the trickle becomes a flood. And the people who have the least income, the least mobility, the least ability to react to this government mandate are the ones who are probably taking it on the teeth the hardest because they don't have any choice. They're going, well, what am I supposed to do? My landlord just bumped my rents, and I don't have any new income to pay for it. The landlord's not prescribed from passing through, and they couldn't be because if they were, then the building would be useless at that particular point. So we seem to have this chaos entering the marketplace from an investment standpoint, where you have to ask yourself, well, if I'm an investor and I want to do good and I want to put my money into things with purpose to help everybody around us, we have to be sensitive to things that are going on. Both at the social acceptance level and at the government mandate level that can blow up a deal. So, if I were a manufacturer of gas-powered lawnmowers, I may suddenly find myself in a state where they're outlawed. Can't do that anymore. So, what are you going to do with all the manufacturing capabilities and everything else? We're just seeing this whole catch-up kind of a thing. Which, on one hand, you can understand it. You're going, well, if it's polluting and if it's harming people, and we're doing things like that, we need to fix it, but our ability to absorb the cost of these changes is going to be like a drag or an anchor on the businesses who have to conform. So, from an impact standpoint, I can see people looking at something, trying to measure as best they can what's the good or the positive coming out of this. At the same time, you got to be carrying a little bit of fear with you that you just invested in a company and it just was essentially obsoleted or outlawed because of these changes that are taking place. And it makes for a more volatile decision making, particularly when you're looking 5, 10 years or more down the road. So, from that standpoint, um, when a person wants to put on the hat and call themselves an impact investor,
Mhm.
what do they do? What would be the first step that you have seen people take to try to intentionally become an impact investor and not simply a return on investment investor?
Yeah, the great question, and I think it really the initial outline of that is that impact investors have dual objectives. You know, they seek financial gains with certain beneficial outcomes for society and for the environment, and so there is a real intentionality to what it is that they do. They very intentionally want to create a positive impact that's not just, oh, it accidentally happened. You know, I'm being very intentional about this. I'm investing my money in a way that doesn't necessarily focus just on the traditional financial investing type mindset. And that can provide me, for instance, a range of returns. You know, there are investors out there who um, getting the absolute top dollar as far as the return goes is not the priority. Um, they're getting a good solid return, but at the same time, they're also balancing and measuring that beneficial outcome for society and for the environment. And so, um, you know, they want to see measurements. They want to see that not only financially the company is making good decisions and doing well, that they're healthy financially, but that issues related to the environment or to a community or to the employee base, society that they operate in, can be measured in a way that sets goals for those companies. We want to reduce our energy usage. We want to reduce our waste creation. We want to focus more on circularity. How, based on what we manufacture, is it use it once and then take it to the landfill, or is it something that can be reused? That and what methods exist for that recycling of that product or that circularity of that product. And so companies are paying more attention to this. Certainly, investors are. They're saying, look, this is the way we used to do it, but there are options to do this and benefit just as much financially, but also not destroy the environment in the meantime. And when you're dealing with a planet with 8 billion people and it's soon to be 9, those are things you probably should focus on. You talked earlier about how do you balance this? How do you balance the dictates of a government that tells you, look, this is what we need to do, and this is what we want to do, and here are the regulations that are in place, with how much I can afford to charge my employees. And not only do communities have to be sensitive to that, because maybe a company says, I can't do business in this community anymore. I can't afford to do business here, and they take their plant or their business elsewhere, or they go out of business, and it's no longer an option for that community to access whatever it was that was being manufactured or sold. And so states have to be aware of it too. Are we going to put in place rules and regulations, as for instance the state of Arizona, that motivates or compels people to move out of the state, or are we going to be business friendly in the state? And what exactly does that mean? We want businesses to be responsible. We want them to be able to operate in a way that is beneficial not only to their bottom line, but also to the community that they're in. And so what can be done? And I constantly go back to, if we as individuals in a society are given options that provide a same or similar outcome, would we choose those options? If you could, be delivered a package of bologna in a package that's biodegradable instead of one that's a single use and it goes into a landfill and it stays there for 1,000 years, would you make that choice? And what I can tell you, Carl, is that there is a group in society that's never going to care about that. They don't care. They're going to look for what the cost is. What's the cheapest thing I can buy? What's the most convenient thing I can buy? There's another segment of society that basically says, I'm not going to worry about this stuff. I never had to worry about it. I'm not going to worry about it now. But there is a big and increasing piece of society that is saying, I do want to make those choices. I am going to make my choices based on, not just the cost and not just the short-term outcome, but what the long-term impact is. I'm not going to buy clothes that are made with synthetics or whatever. These are just examples, but there is a mindset that's different, I think, and I've seen just because of the interactions that I've had with younger people who are making their decisions about purchases completely differently than maybe what my generation did. And
Well,
if there's
yeah,
the hope that I have, it's that group will continue to do that.
yeah. So what I've seen with people who talk about impact investing, I do see a growing trend. It's a very slow growing trend. I have lots of people who are advocates for impact investing. I belong to different groups that are trying to nurture this as a concept. And as you described it, there's a group of people where impact has nothing to do with their decision making. It's not part of their mindset. It does nothing to change the investment decision. On the other end, as we see this growing group, there are people who care, who are looking for a way to use their money, their investment money, to influence and change the paradigm that we've been in over time. And and in between, there are people who says, "Well, I want my return. If I get impact, well, that's icing on the cake."
Right.
But I'm not going to change my decision just because of impact. The impact is setting kind of to the side, and it's a bonus round if they get some impact out of it. But if they're not putting the purpose ahead of the profits, and so we get into that. So and then when you go to talk to people who want to make a difference, what I have seen is that they're like, I don't know how to discern between one choice and the next. And when I work with clients who are raising funding, I say you need to start basically creating a second scorecard. You have your ROI scorecard.
Right.
You need a social impact scorecard or an ESG scorecard or an impact scorecard. And these, when you make a pitch, you need to put them both up. Sometimes, as we described it, nobody's going to care about the second card. They're not going to, it's not going to impact their decision.
Mm-hmm.
But because of this trend that you call it like a consumer-driven force, you need to be sensitive to the fact that more and more people are going to look at their investment decisions, and it's going to influence them. And even if they still want ROI, and they still treat impact as a bonus to their investment, it may make a difference whether they choose company A or company B.
Yeah.
And
Yeah. And that goes back to the risk assessment. To me, I guess I filter everything through that. With a background in finance, I filter it through the risk assessment piece. But it was a big deal a few years ago, and even still, for companies to put out a sustainability report. And in a lot of cases, they were voluntary. In a lot of cases, they just reported all the good things. They weren't required to report the bad things because there were no standards or regulations in terms of that reporting. I always continue to advocate for, and believe that at some point, both the financial statement and the financial statement will contain the sustainability report. They won't be two separate reports because it's a risk assessment. When you look at a financial statement, basically what you're doing is you're analyzing risk. You're seeing what the performance of that company is, and did it meet your expectations, and how does it compare to its competitors, and what's been the process and movement in the market. And so you're assessing the risk associated with the financial activities of that company. And I think it's going to be the same with sustainability, because those things ultimately do impact the finances. What happens when it's found out that somebody's discovered this pipe coming out of the back of the factory that's been polluting the groundwater, and the snakes and the cows and the frogs now have two heads. And so all of a sudden your revenues can be at a real risk. At the same time, I feel sorry for, in some respects, financial institutions. Bank of America, for instance, cannot unilaterally just say, we're no longer going to lend money to fossil fuel companies, because everybody else is going to continue to lend money to fossil fuel organizations. And Bank of America has a responsibility to, its shareholders and its stakeholders to continue operations. And if you cut out, fossil fuel companies, well, I guess, Citibank and Wells and everybody else will be happy because BofA is not there anymore. But at the same time, you can hold up a flag and say, hey, look, I'm not lending to fossil fuel companies anymore, which probably would ultimately be a good idea. But until everybody takes that position, I can't see that it makes sense for a financial institution to unilaterally do that. And maybe they will. Maybe they'll make that kind of bold choice. Not BofA, or I'm not saying a particular financial institution, but some financial institution would make that choice and do that, and maybe that will move the needle. Maybe it will have an impact. Maybe a few years ago there was a big rush to join certain groups, and those groups committed to certain activities. And what you've seen is, especially with political pressure, people backing away from those positions. We're not going to do that. We're not going to necessarily be net zero, and we're not going to So I think it's finding its balance, but I think what motivates that balance is the reality of life. You know, if we are caught in the midst of, you know, continued drought that causes and fuels wildfires, if we have, you know, warmer waters that create, you know, more severe and deadly hurricanes and typhoons, if we continually have, you know, tornadic activity in the south, southeast, Midwest, etc., because of what we're doing in the environment, then, you know, people have to say, you know, people that own multi-million-dollar condos in Miami, I guess you want to be on the upper floors. Despite what some politicians say, you know, the water is rising, and you know, what do you do? What do you do in those cases? I mean, look at Houston right now with the impact with Beryl. I mean, you see just the mess that is, and the continued mess that is now when hurricanes come that way, for a city like Houston, coastal city. So you have to be, you know, at some point, when will the government, and I guess what I'm trying to get at here, Carl, sorry for the lengthy diatribe there, but what I'm trying to get at is at what point will government say, look, for the benefit of all of us, we need to do this. We need to put these things in place. And that you don't have the special interest, you know, winding their way in going, except us, we don't have to do that. You know, where you say, hey, everybody has to do this. Everybody has to abide by these rules. And going back to the EU taxonomy, it's not perfect. There are lots of issues associated with it. You know, they use biomass. Biomass is wood chips. Where do they get their wood chips? From the United States. They import a lot of them from the forests of the Carolinas. You know, and they chop that up and send it across the ocean, and it's used as biomass. Well, that sounds good, biomass. They're burning wood chips. It's carbon. So anyway, it's not perfect, but there does need to be movement, because it's not sustainable. It is not sustainable for us to continue to live and act as if there is no impact and issue by the way we live. We cannot continue to do that, and without huge detrimental impacts. So anyway, you know, that's so I think there is intentionality that necessarily takes place with impact investors, that they're recognizing that they say it's not just about the finances. It doesn't do me any good to have all the money in the world if the world is burning. And, you know, so what is it that I can do to protect this, not only for me and my family and generations that come after me, but for the other people that live on this planet?
Yeah, so a question for you along that line. As we talk about impact investors, it's easy just to stick a label and refer to everybody as an impact investor. But what I've seen is that there's a big difference between an individual, a wealthy individual may act as an angel investor, and say a family office, which is managing their own private money, and a private equity company who is managing other people's money. And so, you know, are you seeing a difference where the private equity company, in order to, you know, keep their clients and to help serve their clients, may have a different approach or a different standard that they use when looking at impact, because they are driven largely by what the returns that they generate for the people who invest into their funds?
Yeah, that certainly has been the case in the past. You don't have to look back very far. You can very easily do a search related to private equity that they were not paying attention at all to issues related to ESG. And that changed. It changed very fast. You see really, really large groups now, groups like Apollo and others, that for new funds, there's a component of that fund that needs to do a materiality assessment of risks associated with non-financial activities. in a particular industry. If they're looking at a company within a particular industry, what are the risks to that industry? What is that company, specific company, doing to mitigate those risks? If anything, what do they need to do in the future? So when a private equity group is now putting together a new fund to build a new portfolio for that type of investment, they are requiring a view that's different than previous funds. And they don't just disappear overnight. Fund one doesn't disappear because of fund two. It's kind of this building of funds that takes place over time. But the new funds are set up and built now such that there is a view of uh, activities related to ESG. And the reason for that, Carl, is those funds are funded by people who are now asking the question, hey, how are you investing this money? And are you doing things with this money that's good for the environment, that's good for society? And again, that clarification of focus when capital is at risk. Uh, a big PE group says, I'm not going to get the money from these investors to fund number 10 if I don't include items related to the analysis of ESG and DEI and materiality assessment and what's taking place within that industry and what the risks are associated with the environment, the changes in the environment. How resilient is my business? Am I located in places where it's prone to flooding or fires or whatever the case might be, heat, which we're certainly familiar with here in Phoenix. So so you're having to look at those types of issues now, which are issues that you didn't even think about 10 years ago, certainly 20
Right.
years ago or 30 years ago. So yeah, I do see that PE groups are very much so now taking a look at all the things that we would uh, identify as impact. What is the impact of the activities that are non-financial that are taking place with this company?
Yeah, so yeah, what I think is driving the trend, as you mentioned earlier, Jeff, is that we're seeing the largest uh, transfer of generational wealth that's ever occurred in the world. It's I forget what the number is. It's a huge number of trillions of dollars moving from the post World War II, the old people like me, to the younger generation. And this younger generation, as I see it, feels like they've been handed a bad deal and that everybody kicked the can down the road and now it's their problem and they've been told you can't do anything about it. And their response has been, well, maybe we can. One of the things we can do is to change how we invest money. So I could see why private equity funds, any pooled investment that's being professionally managed, is going to start having to acknowledge that their customers of the future, if not of today, are coming from people who have this greater concern about all these different things. And if they don't position themselves again competitively to get these investment dollars to come into their pools, they're going to be at a disadvantage to those who have. And so this trend, even though it's multi-generational, and it seems like some days like it's not moved the needle at all on a day-to-day basis. As you said, 10 years ago, a lot of this was not even in the conversation, and suddenly it is. And whether they're measuring the right things or they've got the right scorecard or how they're communicating that, we're in this chaotic transition as we try to figure all this stuff out. So as I work with businesses and communities who are looking to raise funding, I'm trying to explain to them that you need to differentiate yourself. You need to stand out from the crowd by figuring out what impact you have. And impact isn't all just about saving the planet.
Right.
It includes a whole variety of factors, like how many new jobs you create, what pay scale you're paying to people,
Yes.
uh, what kind of mechanisms are you using to help your people be all they can be? And I see a lot of the work that can be done is actually, even though environment may be tied to it, but it has more to do with job generation, with employers working to help provide housing, to provide ongoing workforce training, all these things that come and go, and we've seen it at different times in history have been fairly prominent, and then we seem to back off of that. But it's interesting when you talk to an economic development office or organization, EDO, they keep talking about their measuring stick is the number of jobs, and yet when you talk to a small business, I go, in your offering memorandum, how many jobs are you going to create? There's no information on it, none whatsoever.
Right.
And I'm going, well, if you're talking to this person over here who's only looking at ROI, you're in trouble anyway because you're a small business. Your profit margins may not be
Right.
high enough to attract investment. All these negatives, but at least you could put something in the document that says, well, we created 5 jobs or 10 jobs, and we have a workforce training program to elevate our people to higher paying jobs, or do something else that contributes to the community, that it deals with all the other issues in the community, from safety and crime to arts and entertainment.
Sure.
So it seems like in some ways it's an opportunity for people who are raising funding to make a statement about who they are, what they're accomplishing, stuff they're doing anyway, but they're just not reporting.
Right. Yeah. Well, what great points all. And, business schools graduated generations of newly minted students who ascribed to the Friedman doctrine, which was profit at all costs, and hell with everything else. And I think you're seeing a change in that. I think you're seeing, not that that's not important. It isn't. It is important in the society that we live in. This is what we do in a capitalistic society, and so it is important. That's how we measure success as individuals, as business. That's what we do. But the way that we do it is changing. And again, if I have hope, it's the hope of future generations who are viewing their investments differently than what their parents did. That younger generations have a desire to invest differently. They're catalyzing change. They do exist in large enough numbers that they make, not only from a purchase standpoint, but from a job standpoint, that they're making decisions whether or not to go to work for a company based on whether or not that company's values align with their own. And that's very important. And that gets back again to impact investing. That the basis of impact investing is I'm investing because of the values that I have. And so whether it's investing based on ESG or biblical investing, there is such a thing that they say, I want to invest in a way that aligns with the values that I hold. And so, they're making choices based on that, and it's having an impact. And companies that don't change, that don't see the potential impact of that, do so at their own risk. I mean, it's Kodak thinking that film is here forever, and ignoring digital technology, and suddenly nobody used to have film processors on every corner. You can't find any anymore. There aren't none. And so it's, as goes film, so goes Kodak. And so it's going to be the same type of thing here. Companies that don't change, that continue to do business as usual, thinking that somehow it's guaranteed that they're going to continue to have the same financial performance that they've always had, are in for big trouble. They really
Yeah,
are.
no, the capital industry never sits still. We've seen so many major changes occur over the last few years as a consequence of COVID. And then we saw the heightened interest rates to offset heightened inflation rates.
Mhm.
And what I've seen is a lot of businesses did their business modeling, their strategic planning with the assumption that inflation was low and interest rates were low.
Uh-huh.
And we're seeing businesses close now, large companies as well as small companies, because their business model is no longer viable. Um, and So anyone who's looking for capital, yeah, we look at today because that's where we're at. But from an investor standpoint, the investor's primary date of concern is not today, but when they get paid back their investment.
Exactly.
And if that's 3 years down the road, then what's going to change over the next 3 years that's going to put that payday at risk?
Right.
And the longer the investment, you get into 5, 7, 10-year investments, it seems impossible. And I would tend to agree that nobody's crystal ball is that accurate. But the trend that we're seeing today says that impact may be a little bit of influence today, but it could be a more dominant, if not the dominant factor in investment in the future. And for those who are out raising money, talking to investors who want to see impact, you're going to have to give them clear, concise information
Mhm.
and something that they can hold up a measuring stick to and say, okay, how good did you do? And what do you expect to do in the future? And having this information completely silent or not mentioned at all when you're out pitching for money is going to put you at a disadvantage
They
over
will.
people
Yep.
who are going to take active steps to do that.
Yeah, and I think you have to take much more of a holistic view. You as a someone seeking capital has to take a much more holistic view of how an investor would be looking at that particular investment, whatever that investment might be. That there is an interconnectedness to all of this. That it does take a level of critical thinking to understand, you know, item A impacts item M, and how does that happen? And what you touched on, I think, is absolutely perfect. That it takes a longer term focus, a longer term thinking instead of this short termism. It's short termism has been really great, for if you're only looking at the financial side of it, everything else held equal, counting on everything else held equal. Well, everything else is not held equal. There are huge detrimental impacts by conducting yourself in a way that's just short term. And
Yeah,
so,
so yeah,
yeah,
and there's a number of articles that have come out over the last several months about private equity firms who are having a hard time creating their exit. This is one of the things about an investment is when an investment ends, it isn't like everything disappears and they divide all the money. That typically what has to happen is you have to have a new buyer come in and stand in the shoes of the original investor. And if what a lot of these private equity firms are finding is that whatever investment they've got their money in, there's no takers for what is in that investment pool. And this is why I think long-term thinking is very critical. If I bought a building today, what would appear to be a reasonable, rational, low risk type of thing, and I don't take into consideration that 5 years from now, when I would like to sell the building, get my money back, that the rules may have changed
right,
on how that building is operated, whether it generates its own power, whether it's off the grid,
yeah,
all these different things that might happen over the next 5 years. I
sure,
may find myself with a building that nobody wants to buy because it's old and obsolete, and it's now viewed as a cost for anyone who's taken it over. I'm going to have to take a discount or a haircut on
yeah,
selling off my investment, and we're going to find ourselves, I think, looking at this ongoing type of problem more and more going forward because preferences have changed on what people are going to invest into, and at the same time, we're seeing all these factors that were ignored or not scored being used in the evaluation of those investments. So
Yeah,
yeah, you don't have to think about today, but you have to think about, well, where do I get out of my investment if
right.
I'm an investor? And if I'm a person who is seeking to raise money from these investors, I need to do the best I can to give them that graceful, positive exit from my
Yeah,
investment.
yeah, absolutely. Those systemic changes, the differences in generational values, the motivation of investors to invest in what they do. I mean, it all comes into play. It all goes into the pot that is mixed up that eventually compels people to do what they do in terms of their investments. But I do think that the ingredients in that pot are changing, and that you have to be aware. You can't just, this doesn't happen by magic. I mean, you have to be informed, and it goes back to what I said at the very beginning. It's risk assessment. All of it is risk assessment, and so. Um, there are people that would argue that it's more than that, and I think there are components that are more than that. I acknowledge that, but I clearly see all this again through the filter of risk assessment. So, and how do you exit this investment? And is there going to be a buyer for it at the very end of at your end? You know, um, so yeah, it's interesting. That's the beauty of finance. It's dynamic. It's so dynamic, and it every single day results in challenges as well as opportunities. So it's the fun of that. But I know we could probably talk for hours more on this, Carl. So
We
I
could.
don't keep talking. Yeah,
We do have to wind up. So um, it's been interesting as we've talked today about all the changes taking place that have to do with impact. And in my mind, it seems inevitable that this is going to be a growing decision making, whether it's to invest, not invest, or to choose one investment over another.
right.
And of course, I'm coming at this from the person who has to help raise the funding, figure out who's going to write the checks and why they're going to write the checks. And I just see that right now, most of the businesses, things I'm working with are completely unarmed. They have no data, they have no reporting, they have no mechanism in place to gather the information and go forward. And admittedly, there's no standards out there that says, here's how to do it, here's your checklist, or here's your whatever. But you're going to have to start moving that direction yesterday if you're going to go out and raise money. I think
I
that
think I think you I think you create the standards, Carl. Honestly, I think focusing on what it is that you're focusing on creates the standard for um, what a seeker of capital needs to provide to people who are interested in investing in whatever that business is.
I agree with you. You cannot wait for a third party who may have their own agenda to give you a standard and let them tell you this is what you should do. I think that every business, every community project needs to say, here's the good that we see coming out of what we're doing. Make up your own scorecard and use that at least in the interim until things kind of sort themselves out, but that might be longer than the life of the investment. So
Right, right.
to get something go today. So Jeff, yeah, we've used up our hour here. Thank you for being a guest. Any last thoughts that you'd like to share with the audience?
No, you know what? I'm just excited about all of it. And I would really encourage people to focus on their values and to understand what is available in terms of information that analyzes the non-financial risks associated with a particular investment in whatever that might be, whatever industry, whatever company that might be. But yeah, Carl, I've really enjoyed it. It's always good to talk to you, and thank you for the invitation to do this. And I hope I get another invitation in the future.
Well, thank you to our audience. We had some technical difficulties today, so we weren't able to see the chats and comments and so forth. And it's one more thing for me to work with to improve next week over this week. So we'll see you next week on Tuesday on the Successful Funding Show. Thank you for joining in. Thank you, Jeff, for being my guest this morning. And we'll talk to you again soon.